More now on those troubles at the shipping giant UPS, which delivered some bad news to shareholders today about its earnings outlook for the latest quarter. That despite a record number of shipments. Morgan Brennan has more.
Investors getting an unexpected and unwelcomed delivery from UPS. The shipping giant warning that when it reports earnings at the end of this month, its fourth quarter profit will be smaller than expected. It's also forecasting full year 2013 guidance below the street's expectations. UPS blaming the outlook on an unprecedented level of online shopping that caught the company off guard, particularly a surge in last-minute orders as online retailers like Amazon extended offers. Analysts say the resulting strain on its systems forced it to spend more money.
Operating expenses in terms of extra overtime and in terms of significantly larger temporary employment pool than the company normally would use, to the tune of 30,000 more than they were expecting for temporary headcount.
The season's biggest delivery day came 6 days later than the company expected, and it was bigger, representing a 13% increase from 2012's busiest day. That, coupled with bad weather and a holiday shopping season that was almost a week shorter than last year, meant some packages didn't arrive in time for Christmas, causing the company to refund shipping costs for many customers. While today's news certainly wasn't welcome for investors, analysts do see a silver lining, saying last holiday season's hiccup could actually lead to a long-term growth opportunity.
I think this actually bodes well for UPS because what it does is it validates and maybe even amplifies our expectations for continued online fulfillment that benefits all of the integrated shippers like UPS and FedEx, and in Europe, DHL and TNT.
Still, the shift in consumer behavior is likely to result in more logistical planning and higher operational expenses for holiday seasons in the future. But for a company like UPS, which has enjoyed good cash flow and revenue growth, analysts say the extra costs should not be hard to absorb. In fact, despite today's lowered guidance, the shipper still expects to see as much as 15% growth in 2014. For Nightly Business Report, I'm Morgan Brennan.